Patrick Bet-David has said something about the cross-border payment disruption market that the mainstream crypto analyst community keeps getting wrong in a specific and measurable way. Not wrong about whether XRP has value. Wrong about the mechanism that determines how much value it has and when that value gets priced into the market. And the difference between getting the mechanism right and getting it wrong is the difference between a model that produces a $5 to $8 target and a model that produces a fundamentally different number. One grounded not in chart patterns or bull market multiples, but in the economic math of disrupting a market that generates over $2 trillion in annual fees. Tonight, we are going to build the complete picture. What Patrick Bet-David's analytical framework actually says, and why it is categorically different from the technical analysis approach that dominates crypto YouTube. The three specific errors the mainstream analyst community made when they pushed back on his framework, what the documented evidence from Odell corridor data, institutional filings, and World Bank remittance pricing actually shows about the disruption thesis, what the utility pricing model produces when you apply it to the correspondent banking fee market with realistic penetration assumptions, and the catalyst sequence that Patrick's framework identifies as the triggers for the price appreciation that the chart-based models will miss until it is already happening. Every data point here comes from publicly available institutional research, regulatory filings, World Bank remittance databases, and Ripple's documented commercial deployment. This is not financial advice. Nothing in this video is a recommendation to buy, sell, or hold any asset. This is educational analysis for informational purposes only. Always do your own research and consult qualified financial professionals before making any investment decisions. If this is the kind of analysis that identifies which valuation framework is right and explains precisely why the competing framework is wrong, hit the like button now. Subscribe with the bell on, because the Odell deployment data, the Clarity Act markup window, and the institutional flow data are all moving simultaneously. And when any of them crosses a significant threshold, the breakdown drops here immediately. Let's build this. Start with who Patrick Bet-David is and why his analytical framework is different. Because the credibility of any price prediction framework depends entirely on the foundation it is built on. Patrick did not build Valuetainment into one of the most watched financial media platforms in the world by following the technical analysis crowd. He built it by applying a consistent business fundamentals discipline. How big is the market being disrupted? How good is the team in technology doing the disrupting? What does the regulatory environment do to the adoption timeline? And where is the institutional money moving before retail observers can see it? That is not a crypto framework. It is the framework of a serious business analyst applied to a domain that most business analysts have not studied carefully enough to apply it correctly. When Patrick looks at XRP, he's not looking at a cryptocurrency whose price is driven by sentiment cycles. He is looking at a technology company product, Ripple's on-demand liquidity, that uses XRP as the functional bridge asset for cross-border settlement. And he is asking the question that any serious business analyst asks about a disruptive product. What is the addressable market? What is the realistic penetration rate? And what does the bridge asset need to be worth to support the settlement volume that penetration rate implies? The answer to that question is not produced by looking at XRP's all-time high and applying a bull market multiple. It is produced by understanding the mathematics of the relationship between settlement volume and bridge asset price, a calculation that most retail analysts have never done and that most crypto content never discusses. Here is the market being disrupted, stated precisely, because the precision is what separates the analytical case from hype. The global cross-border payment market processes approximately 150 trillion in transaction volume annually. The correspondent banking system that settles most of that volume charges an average of 1.3 to 1.5% in combined fees across the settlement chain. Correspondent bank markups, nostro account opportunity costs, FX conversion spreads, and processing delays. The World Bank's remittance price database documents the cost at 6.3% for the retail remittance segment and lower but still substantial for the institutional segment. Total fee extraction from the correspondent banking system is estimated at approximately $2 trillion per year. Ripple's ODL product, when deployed in a payment corridor, reduces the cost of settling that corridor's volume by eliminating the pre-funded nostro account requirement and by compressing FX conversion to real-time XRP bridge settlement. The corridors where ODL has been most actively deployed show measurably lower fee costs than the global average. This is documented in the World Bank data and in Ripple's own corridor-by-corridor reporting. The disruption is not theoretical. It is operational and measurable in corridors across Asia-Pacific, Latin America, Europe, and Africa. The question Patrick's framework asks is, if Ripple's ODL captures 5% of the cross-border settlement market, $7.5 trillion annual settlement volume, what does the XRP price need to be to provide the liquidity that settlement volume requires? That is the utility pricing calculation, and it produces numbers that the chart-based bull market multiple approach never reaches. Comment utility math below if you have seen this calculation done correctly before. Because in my experience covering this space, the number of channels that actually run the settlement volume to bridge asset price calculation, rather than just applying a multiple to the all-time high, is very small. Now let me walk through the 3 specific errors the mainstream analyst community made when they pushed back on Patrick's framework, because identifying the error precisely is what makes the correct framework legible. The first error is using market cap comparison as the primary valuation tool. The argument goes, XRP's market cap at Patrick's predicted price would need to reach a level that exceeds Bitcoin's, which is implausible because Bitcoin has first-mover advantage, deeper institutional adoption, and greater name recognition. The error in this argument is treating XRP and Bitcoin as competing for the same market cap pool when they serve fundamentally different functions. Bitcoin is a store of value. Its market cap is determined by how much of the world's wealth wants to be stored in a scarce digital asset. XRP is a payment settlement infrastructure asset. Its market cap is determined by the settlement volume flowing through it and the liquidity reserve required to support that volume at the required velocity. Using Bitcoin's market cap as the ceiling for XRP's market cap is the same logical error as using gold's market cap as the ceiling for Visa's transaction value. The assets serve different functions and are valued through different frameworks. The second error is ignoring the velocity of money relationship between XRP's price and the settlement volume it supports. Most analysts model XRP's price as a simple supply-demand relationship. Patrick's framework recognizes that XRP has a functional price floor, determined by settlement volume and liquidity pool requirements. At current ODL volumes, the functional price floor is below the speculative trading price, meaning speculative demand is still the primary driver. But as ODL deployment scales, the functional floor rises. When it crosses the speculative trading price, the adjustment is a step change, not a gradual move. The analysts who dismissed Patrick missed the mechanism because they were modeling a speculative asset when Patrick was modeling a utility asset with a settlement volume-determined price floor. The third error is modeling institutional adoption as purely demand side. Most analysts model institutional ETF buying as adding demand to a fixed supply, pushing price up. They do not model the supply side. As XRP moves into institutional custody and ODL operational reserves, it leaves the speculative trading float permanently. The speculative float shrinks as adoption scales. The two-sided model, rising demand meeting shrinking float, produces a materially different price trajectory than the demand-only model, particularly in the later stages of the adoption curve. Patrick's business fundamentals framework implicitly captures both sides because it is built on the operational requirement of the use case, not on the demand-side trading dynamics alone. Here is the documented evidence, because the framework only matters if the evidence exists to support it, and I want to give you the evidence precisely. ODL corridor deployment. Ripple has active ODL corridors across Asia-Pacific, including Japan, Australia, Philippines, and Singapore, Latin America, including Mexico and Brazil, Europe, and Sub-Saharan Africa. Each new corridor deployment adds to the settlement volume that creates the functional price floor. The quarter-over-quarter growth in active ODL corridors has been consistent since the product launched at scale. Over 300 financial institutions are active on RippleNet in various capacities. The commercial adoption is real and accelerating. World Bank fee displacement data. The corridors where ODL is most actively deployed show systematically lower fee costs than the global average of 6.3%. The fee displacement is measurable in the quarterly World Bank remittance price database. It is not Ripple's own marketing claim. It is a third-party government-adjacent database that tracks cross-border payment costs by corridor. When the fee displacement is visible in World Bank data, the disruption thesis has crossed the threshold from theoretical to operational. Institutional custody data. Goldman Sachs's disclosed 13F position in XRP ETF vehicles is the largest institutional filing from any Wall Street firm. Standard Chartered has published XRP price targets of $5.50 near-term and $12.50 on regulatory catalyst. These are produced by the same emerging markets research division that applies rigorous quantitative methodology to frontier asset classes, not chart-based analysis. Bank of America holds over 100 Ripple-related patents built over more than a decade. These institutions are not operating on retail sentiment. They are operating on the same business fundamentals framework that Patrick articulated publicly. The convergence between Patrick's framework and the positioning of Goldman, Standard Chartered, and Bank of America is the evidence that the analytical approach produces conclusions that serious institutional capital agrees with, even when the retail analyst community does not. Here is the utility pricing model, the calculation that Patrick's framework implies, and that most crypto content never actually runs. The ODL bridge asset pricing model works from settlement volume requirements through liquidity pool sizing to the minimum token price required to support the volume at the required velocity. With XRP's current circulating supply of 61.3 billion tokens and an effective speculative float substantially smaller than that figure after escrow, institutional custody, and long-term holder lockup is accounted for. The functional price floor at different ODL penetration levels can be modeled. At 1% of global cross-border settlement volume, approximately $1.5 trillion annually through ODL at current velocity assumptions, the functional price floor is in the single-digit dollar range. At 5% penetration, approximately $7.5 trillion annually. The functional price floor is in the range that Standard Chartered's research targets. At 10% penetration, approximately $15 trillion annually. The functional price floor moves into the range that Patrick's framework implies over the medium-term adoption horizon. These are not arbitrary numbers derived from applying multiples to the all-time high. They are outputs of a settlement volume to bridge asset price calculation that is grounded in the operational mechanics of how ODL uses XRP as a bridge asset. The realistic near-term scenarios, Standard Chartered's $5.50 and $12.50 targets on documented catalysts, are consistent with 1 to 3% ODL penetration of the addressable market. The higher targets in Patrick's implied range are consistent with 5 to 10% penetration over the medium-term horizon. Both of these penetration rates are modest relative to the historical adoption curves of successful payment infrastructure technologies. Visa's penetration of the global card payment market took approximately 15 years to reach 10% from commercial launch. SWIFT took approximately 10 years to reach dominant adoption in the correspondent banking segment it was designed for. ODL is 5 to 7 years from commercial scale launch. The adoption curve is consistent with historical payment infrastructure precedent, not with the retail sentiment cycle that the chart-based models assume. Here is the catalyst sequence that Patrick's framework identifies as the triggers for the price appreciation that the chart-based models will miss until it is already happening. The ODL deployment milestone catalyst. When Ripple announces the addition of a major new corridor or a significant new financial institution partner, the settlement volume that creates the functional price floor increases. Patrick's framework tracks ODL deployment data as the leading indicator. The price chart is the lagging indicator. Most analysts watch the lagging indicator and miss the leading one. The ones watching the ODL data quarterly will see the functional price floor moving before the speculative price reflects it. The Clarity Act passage catalyst. When permanent statutory certainty exists, the institutional allocation committees that have been maintaining evaluation status rather than committing to XRP allocations simultaneously move from evaluation to procurement. The simultaneous demand event hitting the supply structure that ODL deployment has been tightening is the price step change mechanism. Patrick's framework captures this because the business fundamentals approach tracks compliance frameworks as part of the adoption timeline analysis. The current Senate Banking Committee markup process, with a realistic July window, is the most advanced legislative position the Clarity Act has occupied. The institutional commitment wave catalyst. When the institutional allocation ratio in XRP ETF flows shifts from the current 16% towards the institutional dominant ratios that characterized Bitcoin ETF maturation, which produced the $40,000 to $126,000 price move over 13 months. The demand driver that Patrick's framework models as the primary price mechanism becomes visible in the ETF flow data before it becomes visible in the price. The 16% figure is the starting point, not the ceiling. The trajectory toward institutional dominance of XRP ETF flows is the leading indicator that Patrick's business fundamentals framework tracks. Here is the portfolio math, translated into terms that are directly useful for the decision you're actually making. At current prices near 1.35, the structural flow that technical analysis identifies at 1.27 represents approximately 6% downside. Standard Chartered's documented near-term target of $5.50 represents approximately 307% upside. The catalyst-driven target of $12.50 represents approximately 826% upside. The utility pricing model at 5% ODL penetration represents upside that the conventional bull market multiple analysis never models correctly because it is produced by a different valuation framework entirely. The risk-reward asymmetry that Patrick's framework implies is not produced by optimism. It is produced by applying a utility pricing model to a settlement infrastructure asset whose functional price floor is rising with each new ODL corridor deployment, while the speculative float is shrinking with each institutional custody addition. The conventional analyst community looked at the chart, applied a bull market multiple, set a $5 to $10 target, and called Patrick's framework unrealistic. The business fundamentals analyst looks at the settlement volume, models the functional price floor at realistic penetration rates, and produces the target that the institutional research teams at Standard Chartered and Goldman are working toward through the same methodology. The conventional analysts were not just wrong about the number, they were wrong about the framework that produces the number. And being wrong about the framework means being wrong about the timing, which means exiting positions before the ODL-driven step change that the utility pricing model predicts and the chart model never sees coming. If this gave you the complete picture, the three analytical errors, the World Bank evidence, the utility pricing calculation, and the catalyst sequence, smash the like button right now. You stayed for the full framework build, including the settlement volume to bridge asset price calculation, that most content never actually runs. And that tells me you're engaging with this at the level of depth that produces better long-term decisions. Share this with one XRP holder who is using a chart-based model to set their price target. Because the utility pricing framework is the missing tool that explains why the chart-based target and the fundamentals-based target are not in the same ballpark. Subscribe and hit the bell because the ODL quarterly data, the Clarity Act markup window, and the institutional ETF flow ratio are all live leading indicators right now. And when any of them crosses a significant threshold, the full framework analysis drops here immediately. Tell me in the comments, are you using a chart-based model or a utility pricing model to think about your XRP target? And what penetration rate of the cross-border settlement market do you think is realistic for ODL over the next 3 years? I will see you in the next one.